Perfect. Well, good morning, everyone. We are going to be presenting today on compensated absences, GASB 101 guidance for New Mexico state agencies. And so as we work through the next 30 minutes or so, we are going to be discussing a few things. We're going to be discussing the guidance, what is changing within GASB 101, but more importantly and more specifically, how it impacts you all and each of the state agencies, what DFA has developed within this principles-based standard to help with the accounting and financial reporting for each of these state agencies. So as we work through this half an hour, we'll talk about the purpose, what we did in assisting DFA with the development of the tools and templates. We'll also clarify what GASB 101 is. So what is changing with the guidance for compensated absences? We'll dig into the details of Statement 101 and specifically tying this to the state of New Mexico approach. So whether or not you're a GASB 101 expert or this is your first hour of this learning about this pronouncement, there's something in it for you. At the end, we're going to recap the key changes in the guidance, and then we'll turn it over to Mark to go over a hands-on walkthrough of the two templates that have been developed to make this as seamless as possible for New Mexico state agencies. Again, the purpose of this training is to provide the guidance for state agencies for identification and reporting of compensated absences as required by both GASB 101 and by MAPS. When you work through reporting, accounting financial reporting for governmental entities, GASB has these new pronouncements, right? Like this one is the pronouncement 101 on compensated absences. But what they also have are concept statements. So these statements help to frame how GASB thinks about financial reporting. And for state and local governments, they have 6 characteristics that are lined out. And 4 of those characteristics I really want to point out because we really tried to lean on those as we were working with DFA and in implementing GASB 101. And those would be understandability. We're hoping that what we've presented to you today will make your financial statements more understandable. Timeliness. What has been pulled together today with the work over the past few months should make it easier for you to get this information into your financial statements and to book those entries. Consistency. Mark mentioned that statewide approach. We are really looking at this in terms of what can DFA put into MAPS that will help provide consistent guidance that does follow what GASB is looking for across all state agencies, and then comparability. So depending on the type of agency that you are, you may have some individual quirks, right? No 2 agencies are different, but really in leaning on what GASB one of the characteristics of financial reporting of that comparability, we really want from agency to agency, to the extent that GASB provides this guidance, to provide that comparability. So if you're looking at one agency compared to another agency, you're seeing apples to apples in terms of the financial reporting. So what is GASB Statement 101? This is changing your accounting for your compensated absences. The previous guidance related to compensated absences, what we currently follow is GASB Statement 16, and that was issued in November of 22. Issued in June of 22, but it came out in November 22, and it was effective for years. Oh, sorry, it was issued in November 2002. Yeah, I was reading the other one now. The GASB 101 is issued in June of 22, and it is now effective for this first fiscal year. And what this is doing is it's creating a unified framework for all of your compensated absences. And you're going to take the same recognition criteria that we'll look at here in a couple of slides, and we are going to apply that to all of your compensated absence types. So previously, what you would be doing is you'd have a different type of recognition for your annual leave versus your sick leave. What this is doing is saying, let's take a look at all of your leave types and let's apply the same recognition criteria. What that is going to be doing, in effect, and you'll see later, is you're going to have a liability for your sick leave that you didn't have in the past. I'm going to emphasize this here, and I'll emphasize it again. This is not changing anything in terms of how the state or how any governments pay out their leave. This is not changing anything with any of those types of benefits that are being provided. This is simply an accounting change to apply more consistent accounting for all of your types of compensated absences. So where are your balances for compensated absences? So this is a look at the state's 2023 financial statement. And it's going to be found in the other liabilities area of your financial statements. In addition to that, you do have a note disclosure that will show you in a little bit that points out where your accrued compensated absence balance is. So this is the balance that we're talking about today and what is changing with it. The other thing I want to note and to kind of continue to emphasize is that this approach is principles-based, not rules-based. So there are going to be assumptions that are made, and there are assumptions that DFA made within the guidance to help you with the state of New Mexico's approach. So the next thing that I'd like to do is to dig in a little bit to the details. And this is layered in two ways. Here's what GASB says. Here's what the paragraph is in Statement 101 that says what is changing. And then here is how the state of New Mexico is approaching it. From that, this approach, you're going to see SNPs. A lot of these SNPs are from the templates that Mark will then go through in the second part of our presentation after I do my portion. So anytime you have a new pronouncement, you typically going to start with a definition. So they define what a compensated absence is. So a compensated absence is a term used to describe leave that entitles employees to receive one or more of the following. So cash payments for leave, when leave is used for time off, other cash payments such as being paid out upon termination of employment, or non-cash settlements such as conversion to a defined benefit post-employment benefit plan. Some examples of what a compensated absence is: annual leave, sick leave, holidays, parental leave, bereavement leave, certain types of sabbatical leave. So those are the types of things that are compensated absences. You will see later on in our presentation, we've identified the leave types that you are given as an employee for the state of New Mexico and the different type of leave types for each state agency. Compensated absences do not include sabbatical leave, during which an employee is required to perform different duties. That typically happens in higher ed, as well as termination benefits. So how to identify a compensated absence? So there's a lot going on the side, so you're going to work with me. We're going to look at the left side first. So first, does it meet that definition that I just went through? And that is in paragraph 3 of GASB 101, where is an employee able to receive one of the following? So cash payments when leave is used, other cash payments, or non-cash settlements like we touched on. If they are not able to, it's not a compensated absence. If they are, then let's move over to the right side. There are specific exceptions within GASB 101 where they say, yeah, it probably does meet the things on the left, but we're going to make an exception of it because it probably applies to a small portion of the population. So they line up some of those. So they say parental leave, military leave, jury duty leave, holiday leave taken on a specific date. Those types of leave are exceptions, and you don't need to worry about recording a liability for those. If you're meeting a yes on the left side, but then and it's not an exception, then you move to what's called the recognition criteria, where then you determine if it requires there to be a liability. So how do we document this? How do you, of all of the leave types that you all are offered, how is that documented? Well, you'll see in the tool that this has been built for you all, depending on if you're legislative, executive, or judicial branch. We have built out the leave types with you on working alongside DFA. And why is this helpful? Because in the first year of implementation, you kind of want to get everything down. Even if it's not material, even if you have smaller balances for certain leave types, you want to document it to show that full, comprehensive, thoughtful approach. So we'll be able to show you how you're documenting the different leave types and which ones meet that criteria here in a minute. The recognition criteria. So how do you determine if there is a liability? There's three factors that you consider. And again, we'll show you how DFA has done a lot of this consideration already for each of the individual state agencies. But if you have a leave type, so annual leave, sick leave, compensatory time, this is how we evaluated it. One is the leave attributable. Has the employee earned the leave? Meaning, because you worked those 2 weeks, did you earn that incremental portion of that leave? And do you have it in your bucket and is it yours to use? Secondly, does it accumulate? Does it carry forward to future years? So past June 30, does it carry forward and can you use that leave, in July 1 and beyond? And third, is it more likely than not to be used or paid? And more likely than not refers to a greater than 50% threshold, and we'll touch on that later. The one thing I want you to see now is it's not just paid out. So right now you accrue a liability for your annual leave that is paid out, right? This is saying that's great, but we also need to evaluate the amount of leave that is more likely than not to be used. And we'll show you how you can think about that and how DFA has thought about that more likely than not to be used. Again, this is very principles based, and GASB gives us a framework to think about it, but it is an estimate. There are some assumptions that are being made to determine how much of that leave is more likely than not to be used. There on the right, you can see those exceptions that we already touched on. So what does that mean for state agencies in New Mexico? DFA has determined that all state agencies will include the following compensated absences in their liability calculation. So these are the ones that meet that criteria: annual leave, sick leave, premium overtime, and compensatory time leave balances. And there you can see the different codes that fall into compensatory time leave balances. Should a state agency believe that they have other leave types that meet that recognition criteria and they believe that they are material to the agency's financial statements, the agency should contact the Department of Finance and Administration for guidance in making that more likely than not determination. Again, we took a look at all of your leave types. We took a look at all of the balances within the leave types, and this is how we landed on those four. Right? We did some analysis in terms of exposure, in terms of potential liability, and for state agencies in the state of New Mexico, these are the large types of compensated absences that could have a liability associated with them. So how do you document this? This is also designed to auto-populate based off of determinations made by the Department of Finance and Administration. Again, in thinking about the timeliness, consistency, comparability, a lot of this effort was done on behalf of each individual state agency based off of doing an analysis at the statewide level. So we touched on that more likely than not to be used. So how did DFA come up with that estimate of the amount of sick leave that is more likely than not to be used or paid? Or in evaluating all of the different types of leave. So you can see here that more likely than not means above 50%, right? 50% and a feather, more likely than not to be used. That would then trigger recognition for a liability. Again, this does not trigger anything in terms of payout, usage, policy with any of your leave types. This is simply how you would determine if a liability needs to be recognized under this new guidance. In paragraph 12 of GASB 101, they give you criteria to consider to determine how much is more likely than not to be used. They say, look at your employment policies of the state government. Look at the eligibility for use or future payment. Look at historical use and payment of leave. And look at, are those historical trends representative of current reality? And they really put that in there because depending on what historical usage you look at, you might have some COVID years in there and you want to make sure that they're not skewing the more likely than not usage on a regular year kind of going forward. And so again, this is principles based. This is the criteria that is put out by GASB. What DFA has done is they've gone through these four different areas. They've really looked at the historical use and payment of leave, and they helped to then determine how much is more likely than not to be used. So DFA utilized employment policies, organizational knowledge, and historical data from fiscal years 23 and 24. So looking back, how much was actually used, depending based off of the different employees' leave balances, to develop that more likely than not expectation for the liability. These expectations have been integrated into maps and will be utilized by agencies in the compensated absence liability. So what you're seeing next, what you'll see next is incorporated in maps and is how you will what percentages you will utilize to calculate your liability. So let's look at them one by one. Annual leave. Annual leave, more likely than not to be paid or used, is going to be accrued at 100%. So you're going to take the total balance of annual leave for all the employees, multiply that by 100%, and then add salary-related payments. We'll look at it in a minute, and that is your compensated absence liability for annual leave. Now, the state does cap at 240 hours, but that is on a calendar year basis. So what we did is we looked at the leave balances for those over 240 hours, and what we determined working with DFA is that most of that leave is used by the time you get to 12/31. Now, of course, we know if you look at individual by individual, you're not going to get to 100%, but again, these are estimates. And based off of the historical usage of annual leave, most of that leave does go down more towards that cap amount by the end of the year. Sick leave. This is the one that had the most work done for it to try to determine what amount of your sick leave that you currently don't accrue for would need to now be accrued for based off of this guidance that GASB has in 101 of more likely than not to be used or paid. So you have two different buckets here. And again, this is all built out for you in the template, so you don't need to be writing it down and trying to figure it all out right now. But the more likely than not to be paid. So balances at the measurement date, so at June 30 of each year, that are greater than 600 but less than 1,000 hours. So that portion of leave it's been determined that 60% of that is more likely than not to be paid. Within that, you have the up to 120 hours that can be paid out annually, and you also have the up to 400 hours that can be paid out upon retirement. So based off the analysis of all of that sick leave between 601 and 1,000 hours, it was determined that historically around 60% of that is more likely than not to be paid. Then DFA also looked at the amount up to 600 hours. So the amount that is not paid out, but the balances that each individual and each agency has of sick leave by employee up to 600 hours. Through historical analysis of 2023 and 2024, it had been determined that the amount that is more likely than not to be used as sick leave is 50%. Now, the state of New Mexico does not have caps on these. It's also pretty generous sick leave policy. So a lot of you all at agencies have very large sick leave balances, right? The amount of the sick leave that your employees have earned is pretty large. So what you're going to see is because you're adding a liability for sick leave, your compensated absence liability is likely going to double, or maybe around that amount, depending on the agency, because GASB is now requiring through GASB 101 to accrue a liability for some of that is more likely for some of that sick leave that's more likely not to be used, and then above 600 hours more likely than not to be paid. Two other types that are also going to be included in the liability: premium overtime. That is going to be included at 100%, and the compensatory time leave balances of those categories that we showed you in the previous slide are also going to be accrued as a liability at 100%. Again, this analysis was principles based off of paragraph 12 historical data, doing that analysis to come up with at a statewide level, looking at all of the leave used for all of the agencies, and this is what was determined. So how should you calculate this? Well, DFA has built some share reports and that they will show you to help you with calculating these balances. So you're really going to be pulling information from developed share reports, inputting them into the tool that has been created to help you provide that calculated value. And so Mark will work with you here in a minute on working through what share reports to use how to input the information, all of those types of things. The liability should be measured based off of the pay rate at the date of the financial statement. So what people are being paid at June 30, 2025, 2026, 2027, that is the rate that will be used to calculate that liability. You'll also be including the salary related payments, and both the pay rate and the salary related payments are already taken into account in the liability template. So utilizing those share reports, it's going to calculate that out for you to give you that total liability. The other estimate that was completed on a statewide level by DFA is the amount due within 1 year. So as you know, when you have a long-term liability, you have to determine not only the total liability balance, but what is the amount due within 1 year. And again, going back to GASB Concept Statement 1 about consistency and comparability across agencies that all roll up to the state's ACFR, an estimate was made using historical statewide data to come up with the more likely than not to be used in 1 year. And a rate of 70% was identified that determined, okay, we believe that 70% of that liability would be a current liability and shown as due within 1 year. DFA would also like to point out that that percentage will be reviewed on an annual basis and will be updated as appropriate. So whenever you have the journal entry, and we'll show you the journal entries here, you have a short-term portion and a long-term portion. And so 70% of the balance will go to short-term, the other 30% will go to long-term. Transition. So this is big. When you have a change in accounting principle, you have to go back and restate to the balances at the beginning of the earliest period presented. So what we're doing and what you're doing in this implementation year, just like you did for GASB 87 and GASB 96, is you go back to those beginning balances. So that June 30, 2024 balances and determine what your restatement entry would be. And so in this first year, you will have two different entries that you will need to make. The first on the left-hand side is for the year of implementation, where you're going to be adjusting your short and long-term liability. And the other side of that entry will go to your net position. As you can see here, the account for most agencies that you'd be using is that unassigned fund balance category. But that is a restatement entry in accordance with GASB 100. Anytime you have a change in accounting principle, that's what you're going to be doing. And so you'll be doing that to get the balances at June 30, 2024, as if GASB 101 were in place for your start. For future reporting periods, so for June 30, 2025 and onward, you will be doing the entry and where you're hitting the short and long term, and the other side of that entry will be a salary expense account, and they've laid out which accounts you'll be utilizing for those for consistency. And so at transition, you'll have the first entry. Let's get our balances as of June 30, 2024. Then let's go ahead and get our balances at June 30, 2025. That way we have it for this financial reporting period. And you'll see in the templates how those are all built out. Note disclosures. Thankfully, there are no new note disclosures, and actually simplifies the existing guidance here in GASB 101. The increases and decreases in that long-term liabilities roll forward will be netted now instead of showing an increase and a decrease. And you're no longer required to disclose the fund typically used to liquidate compensated absences. So to show you an example, this is what the note currently looked like. This is the 2023, but this is what it currently looks like. I'm sure a lot of yours look the same, where you have a compensated absence balance, you have an addition, you have a deletion, you have an ending balance, and then you have that amount due within 1 year. What you're going to see now, and this is just an example, is you're going to see that you're just going to net it as one amount. So whatever the balance was at June 30, 2024, then you get the balance at June 30, 2025. The difference you just put in that amount as a net amount, and again, you'll show that amount due within 1 year. Recapping the key changes. Continue to emphasize that this is a principles-based approach. There are not very strict specific rules set out by GASB 101, right? They provide these principles, and then the state and DFA have put out the accounting policies based off of those principles. It is no longer a vesting. Is it paid out? Okay, then I record a liability. There's that recognition criteria that we touched on, and it is going to impact most significantly your sick leave. Again, not how you're paying out, not your policy, not the benefits that are provided to state employees, but simply the accounting now that now triggers a recognition of a liability for some of your sick leave. And that evaluation is done based off of, is it more likely than not to be used or paid? And we use that more likely than not criteria. So an estimate of how much of that leave has a greater than 50% likelihood of being paid out. Lastly, before I turn it over to Mark and team and open it up for initial questions, what DFA is providing. So Statement 101 is bringing changes, as you've seen in the presentation, but DFA has worked over the past few months to develop implementation guidelines and policies to enhance the implementation and reporting of Statement 101 for state agencies. So materials that you all will be provided. The MAPS policy that outlines those specific requirements. So those different percentages, how you're required to report, to do within 1 year. So MAPS will be updated for this new accounting guidance. In addition, you're going to get a compensated absence summary template. So this is going to take all of the type of compensated absences that you could have, depending on your agency, and it helps you answer for your auditor which ones meet the definition of recognition under the guidance. Then you will also receive a liability calculation template where we pre-populate the formulas, the percentages, set up the journal entries to where what you're doing is you're just taking your balances at June 30, 2024, at June 30, 2025, and inputting them into this template, and it's doing all of the calculations for you. Share reports have been configured with the data needed for that liability calculation template. So really, as long as you're pulling the data down, and we try to make it as clear-cut as possible, pulling the data down, putting it in the buckets, it is going to give you everything that you need. Some of the key determinations that have been made for you on a statewide basis to promote consistency and comparability are the more likely than not assessment for annual leave, sick leave, premium overtime, and compensatory time leave balances, as well as the amount due within 1 year. I will tell you that if you all at an agency by agency level were to attempt to do this yourselves without this guidance, it would be, a 4, 6, 8 week process taking probably, 100, 200 hours of your time in accounting and financial reporting to do that statistical analysis, to look at that historical data, to land on and to figure out those assessments. So I think it's great that DFA has taken this approach and has invested in our assistance and our guidance, and also invested a lot of their time, in working with Mark and team to get this right and to get this down for you and to have this all built for you all and to be presented to you before your June 30 year end. So Mark is going to go through in the next parts of the presentation that summary template and the liability calculation and kind of show you how that works, a little bit more hands-on basis. But with that, I'm going to go ahead and open it up to questions, turn it over to Mark. The other thing I'd like to point out, we are going to work with DFA on a FAQ document. So some questions that come in that aren't just agency specific or circumstances specific, but if there are any questions that we're getting numerous times, we'll try to put that together in an FAQ document and along with DFA. That way you all have that guidance as well.
All right, thank you, Danny. And if Bailey, if you'll stop sharing your screen, I'll share mine here in just a second. I think let's hold off until we get through the templates on any questions, and then we can go to the chat, or we can let you all raise your hand with any questions. So what I'm going to do next is I'm going to go through the templates that Danny's laid out for you. We'll show you the summary template that goes over the types of leave based on branch of government, which is used for your audit documentation. And then we'll go through the actual template where you can calculate what your liability will be. And bear with me. I was not prepared to present this until yesterday, so I had a crash course in this exciting information yesterday, but it's really good. And Audrey, Beck, and Heather are both here with me today, so if I mess anything up, they will step on the break and let me know. So let me share my screen real quick. So Audrey and Heather, if you can make sure you're ready to jump on. Are you all seeing the first template? Yes. Okay.
Yes.
And I'm probably going to turn my camera off. Obviously, if you've been to a DFA Teams meeting, sometimes our internet gets bogged down. So I'm going to turn my camera off while I'm presenting just to try and prevent anything. This is going to be a little complicated just because you have templates and you have queries where you're going to be pulling some of the data from. So, having two monitors is important here so you can kind of look at both. We won't be able to do that today, but I'll show you which ones we're using, where they came from, and where we're getting the figures from. And all of that. So we'll start with the kind of summary template, and you'll see when you receive these, and you'll be receiving all of these templates and the policies and everything next week as we get closer to June 30th. The queries and share are mostly done. We're still tweaking a couple things on the queries just to make sure they're ready for go live, when you start pulling this data in July. But you'll get all of this from us. So just, you don't have to take a whole lot of notes. You'll get this. The folks have done a really good job in adding instructions to every tab, every step along the way. So my recommendation to you all is, as you're going through these templates, read what's there. It really outlines everything you need to do to get to the final correct answer. Okay, so this is a summary tab where we're just going to break down what types of leave the agencies have, what's applicable to the reporting period, and then this you would say for your audit documentation and to share with your IPA as they're doing their test work. And then you'll see you're going to copy and paste a little bit of information from here into the transactional template where you actually calculate your liability. So first tab is just the introduction. A lot of what Danny already went over today, so I'm not going to rehash that. Okay. But when you go to the second tab, type 1, step 1, types of leave, this is where you identify your agency and your branch of government. And then the majority of everything else will be pre-populated for you based on that test work that DFA has done over the last 6 months of building this process in place with Cherry. Okay. So example I'm going to use today is DFA 34100. So that's our business unit. And then in this drop-down box, and you can see the instructions are here for you. Make sure you read those. Hit that drop-down, pick your branch of government. We have 3 different branches of government, all with different salary plans and leave types. Make sure you select the right one, because then everything will be pre-populated based on your branch of government and the the leave policies that are in place at those branches. So for DFA, we're executive branch. So you'll see as soon as you select your branch of government, all of the types of leave that are out there in the world of state government will pre-populate for you. That doesn't mean all of these will be calculated. This is all that's available. And then we will work through showing which ones will be calculated. So that's tab 1. You can read some more not examples, but explanations here in the tips and tricks if you have any questions. Okay. There's a note column here for if you wanted to add any notes pertinent to your agency. I don't think it's necessary, but some of you all may want to put some notes. It's there for you if you want to use it. It's not going to transfer anywhere, but you can add notes if you want. Okay. Moving on to step 2. This is a lot of this has been pre-populated for you based off of all of the state's leave policies, as well as the state laws surrounding what we pay out as state governments. And most of these questions, all of these questions will generally be pre-populated and answered based on your branch of government and your leave policy. So there's really nothing you need to do here other than verify that everything is correct. And if for some reason you find something that's not, you'll reach out to DFA and your ACFR folks, and we can help you through that. Okay. Step 3, we outline the exception. So Danny went over earlier what's in scope and what's out of scope. So step 3 is that kind of review process of what do we have to report, what's accepted from the GASB pronouncement, and it gives you an explanation of each one, whether it is or it isn't, in accordance with the GASB guidance. Again, All of this is pre-populated for you based on that process that DFA went through with the contractor, but you need this for your audit support. Okay, and again, read the instructions. It's all lined out very clearly for you. Okay. Step 4, recognition criteria. This is where we get to what is in scope and what needs to be recorded as a liability for your agency. Again, all pre-populated based on all of those decisions and all of that process that we built in place, but review it, make sure it's all correct, read your instructions. Okay. All right. And then the last tab is just the final product. This is what you, your state agency, are going to record as your compensated absences for fiscal year 25 and your restatement for fiscal year 24. So you'll see you're going to kind of copy and paste this information into the template where you then do the final calculations to get to your liability. But all of this is part of that audit documentation, part of your responsibilities to review and make sure that everything is correct and that it applies to your agency. And if you run across something that you think is incorrect or doesn't apply, like reach out to us. But I can tell you we've spent a lot of time trying to make sure this is all right for each branch of government and standardizing it across the state. Okay, so that's the first template. You would save this every year. It would be part of the documentation you share with your auditors when they're doing their test work, or if they have any questions about how you calculated compensated absences. And then obviously, as Danny mentioned earlier, if they need further information, DFA has documentation that we can share with them on how all of these things were calculated and all these determinations were made. Okay. All right. So that's the first one. And then you would move on to your second template. And I have it on my other screen here. So this is the actual liability calculation template that you're going to be using. And, you know, it's not, I'm going to say it is going to take you a little bit of time. It's not like it's just cut and paste and everything moves real quickly. You got to go through each type of leave. You got to make sure it's calculated correctly. And same thing as the summary tab. Everything is provided for you instructionally at the top, and then you work through each of the requirements. So the first page is just an introduction to the calculation spreadsheet. Read that, but we've already kind of talked on a lot of this stuff today. The second tab is where you're going to copy and paste your information and obviously update your business unit here, but you're going to copy and paste that information that we pulled from the first template, just so you are identifying which types of leave you're going to be reporting as a liability. So we'll go back to the first one. We're going to copy and paste what's here. And this is in the instruction. It tells you to do this. Okay, so now you have which ones you're going to calculate. Okay, and then again, audit documentation for your records. Save this for yourself and for your auditors if they have any questions. Step 1, move on to the next tab, gather the data. So this is where we have created the share reports for you to pull the data and be able to use. And I can tell you these reports are really good. I've seen the reports we've used in prior years, and every agency kind of had their own way of doing it. It is a little complicated. We have 4 queries that will make this all so much easier for you all. Let me get into share and I'll show you what those are. So bear with me 1 second here. I will point out, like, don't go out and try running all of this now, right? You can't really do your compensated absences calculations until after the final pay period. So not until in July, because if you pull it now, it's not final. There's going to be changes to it. We're still tweaking the queries a little bit just to make sure everything is working well. But by June 30th, when we send all the guidance out, they'll be done. And I have to remember what the names of the queries are, so bear with me here for a second. And we will send all of this to you with all the guidance as well. So these are the 4 queries you see on your screen here, these GASB queries. And a quick kind of summarization of what they are. You have 2 queries for each type of leave. So you have the leave liability is sick and annual and donated. And then the comp is all of the comp that will be included and all the various types of comp. There's a summarization query, which kind of creates a pivot table for you, summarizing all the data, which is really what you are going to use to populate the templates. It is a very simple thing to do. But then the full query gives you line by line data of what that summation is. So if your auditors want to test it, if they want to see the raw data, you can pull that. But to build the templates, I would recommend using the sum, and that's what we're going to do today, and I'll show you. But the sum is just a pivot table of the roll-up types of leave based on overall liability at each agency. You run this for your agency for each fiscal year. And then the same thing with the second query. This is for your annual and leave. So these are the ones we're going to use today. I'm not going to pull them right now because that would take a little time. I do recommend that probably scheduling these queries is probably the safest thing to do, especially if you're a larger agency and you have thousands of employees. These are HCM queries. They are pulling a lot of data. Schedule them just to be safe. And you'll always hear me say that, schedule when in doubt. Schedule the queries just so you don't bog the system down. Okay. So I've already run all the queries, and I'll show you what they look like. And again, I ran them today for DFA agency 34100 with the understanding that it's not complete. It will not be complete until the final pay period of the year is over and all of the processing is done and the accruals are banked. So for now, it's just, it's not complete. So this is the summarization query for your comp time. It summarizes your entire agency by plan, ending balance, hour balance, and liability. And you'll see that these titles are important as you get into the templates, okay? And then same thing for the sick and annual leave summarization, okay? So this is what you're going to use to build your liabilities at your agency. And then again, you can run the larger queries if you want to look at the raw data and make sure this is accurate. I can tell you it is. We have tested it left and right, and we've broken it and had to fix it. So we're pretty comfortable that everything is pulling correctly and accurately, but you can always test it yourself. I would highly recommend you test it yourself because it is your audit and they are your financial statements. Okay. So for the first year of implementation, you're going to see as we get into the template. So we're going to start with annual leave, and I'm trying to make this big enough for everybody to see. You're going to see, and Danny mentioned the restatement. So you're going to have to pull data for FY24 and FY25 because you have to get that restated balance to start with, and then your final actual balance with the 25 numbers. So you're going to have to pull 2 queries for each type. Now, once you get into fiscal year 26, you're only going to have to do that on a go-forward basis year by year. But for the implementation year, which is 25, you're going to have to do both. Okay, so that, and you'll see that here, and you'll go up, you come up top, and it gives you all the instructions. It tells you what goes in what cell, where to put it, how to do it. And this is the implementation year template. There is a second template for year 2 and forward where you don't have that prior year restatement built in. It'll be a little bit easier. But for this year, we have to use this template. Okay. All right. So we're going to go through this. Again, it's telling you what to pull, where to pull it from. It's telling you which query do you use for, and we're doing annual leave first. So you pull this query, which we have. Okay. So let's find that query here. So this is the 2025 query, and then I have the 2024 query. Something to know, and this is where it's going to get a little complicated because I'm going to have to put something on the other screen so I can see back and forth. But if you look at these titles here, they correlate to, sorry, the boxes here in red. So you'll see in red is the title of the column you need to pull the data from on the query for each of the types. So that's very helpful because when I started doing these and testing them myself, it took me a little while to figure out until I realized the titles matched up and it all made sense again. Okay. So with that, I'm going to move my 25 query just over to the side. Actually, no. Let's talk about how you do this first. You all will come up with your own ways to do this once you get more comfortable. But the instructions tell you the first thing to do is to set your filters. So turn on your filters for row 2 so that you can filter what you need. So for the first tab, because there's 4 tabs, because there's 4 different types of leave being reported. The first tab you're working on vacation. And if you read the instructions, it tells you vacation and donated leave if you have a balance in the donated leave category. Now, as you can see for DFA, we did not have any donated leave. We have sick and vacation. So for my first tab, really all I need is this vacation. So following the instructions, you would filter, pull out sick, you just have vacation. Now, if you had donated leave, you would also check that box. But at this point, you can pretty much copy and paste and make sure you know which year you have. Probably best to do 1 year at a time because you're doing 24 and 25. I named my spreadsheet so I know which is which. Copy and paste. On the vacation tab, you can and sick on the vacation tag you can copy and paste. The sick one is a little bit more complicated because there's more boxes. But copy and paste your vacation balances into your spreadsheet. Here, current year, this is FY25. So now you have your total hourly balance as well as the monetary value. Okay. And that's what these instructions tell you. And then same thing for FY24. So let's go pull the FY24 report, which is here. Filter, turn on your filters. And you can see in FY24, DFA did have some donated leave. So in this instance, you need to keep that on there because you have to calculate both of those. You would uncheck sick because we're on vacation right now. And then you're going to sum because you need the total. So sum these up. Okay. And now this is what you're going to copy and paste into the spreadsheet for FY24 because the restatement requires you to calculate your ending leave balances as of 24 based on GASB 101, not what you did in your financial audit. Okay. So copy and paste. Put them down here. And you'll see later where all of this information is going. Like, or not, it's not just sitting here. Everything is mapped into all of these pretty little spreadsheets that we're going to get to here in a minute. But you got to go through each of the leave types to get to where you need to go. So now you have your current year, so your FY25 vacation, and you have your FY24 vacation and donated leave if it's there. Okay, so that's step one. Use that query. Input your information. Okay. The next tab is sick leave. This one's a little more complicated because there's more rows and there's more calculations, and I don't think, Audrey, we got this lined up yet. So I don't think we can do a simple copy and paste yet because the columns
I believe it is lined up, Mark.
Is it? Okay,
It
let's double check that because yesterday it was not. So getting back to your queries, and we're on 25. Now you want to unfilter. This time you want to go for sick leave. So check your sick leave box. Okay. Now you have all the columns. Let me pull this over and just see. Yesterday we didn't have this all lined up. Hours balance. Yeah, it's still not lined up, Audrey. Okay. So we still can't do a simple copy and paste over. It looks like, and Audrey, if you can make a note of this, because we do want to clean this up before it goes out. Columns C and D are not there. Yeah, definitely not lined up yet, Audrey. So if we can work with the developers before this goes out live. And those are the kind of tweaks that we're trying to fix. That way you can just easily copy and paste the rows over, but we can't. But again, as I mentioned earlier, you can see on here, the red is what's really important. You'll see the first column, hours balance, aligns to the title. The second one, you can see it's sick balance to 600, which is actually column E. Hours liability is C. Sick balance greater than 600 is F. And then greater than 600 sick liability is D. We hope to have that in the right order before June 30th so you can copy and paste. But for now, you kind of have to go one by one. So I'm going to move that over to my other screen and just get all that information in there really fast. And you can just kind of copy and paste everything based on the titles. Sick balance to 600. So just bear with me as I copy all of this stuff in. And again, these are all of those categories that Danny was mentioning as he was going through his presentation and the different calculations on the 600 up to 600, the 6 to 1,000 and all that good stuff. Six balance greater than. We got to get these columns lined up properly, Audrey. I don't want to have to keep doing this.
I think it's lined up in Fix, and they hadn't moved it to Project because it was lined up yesterday afternoon. So I apologize.
It's all right. We will get this all lined up for you all before we send out these queries and go live. Okay, so now we have the 25 numbers. Now we pulled the same query. We're on 24, but we need to go back in here. Let me remove these. Do your sick. Same thing. You're going to input these numbers into your prior year. So let me move that to the left. And we'll just start copying and pasting based on the titles. And bear with me. I know this is painstakingly information for me to copy and paste, but.
And Mark, I would like to point out that if you notice the wording in red matches the wording on the query. So if you're ever wondering how those line up, the wording in red matches exactly what the column labels on the query are.
Yeah, and like Audrey's mentioning, I'm trying to show it to you all. It's kind of hard to get it on the screen together for you to see, but if you look at the query, you can see the red hours balance matches the title, and eventually we'll get those lined up for you. But one of the things that I was, Heather and I were doing a lot of testing this week and kind of going back and forth just to make sure all of this stuff was working. Like, double check. Like, I test this because I can tell you yesterday when Heather and I were doing this, one of us had flipped these two. Like the liability was here and the number of hours was here. And I caught it by just looking at it like, hey, it doesn't make sense that there's 400 hours in the current year, but 4,000 last year, right? So you can kind of eye test it. It's not going to be perfect for everybody, but it's easy to copy and paste something in the wrong box, especially now since we don't have them in order. Like, just verify it, make sure it makes sense, because this looks like decent. We expect there to be an increase in the second year. This kind of makes sense. Numbers look familiar. So just kind of eye test yourself. Okay, so that's your sick. And again, all of this is in your instructions up here. It tells you exactly which cells to put which ones. And I promise you, I commit to you all, we're going to get these columns lined up properly for you before we go live, before you have to calculate this in July. Okay. All right, so that's your sick leave. Next tab, premium overtime data. So this is that premium overtime. Now you're going to use a different query for the next two tabs because premium overtime is included in the comp tab, in the comp query, and we'll show you how to do that. But the name of the query is right here. So this is a second summarization query that you'll use. Okay. And I've already pulled the data. So this one is for FY25. So we'll start with this one. Again, turn on your filters because you have two different types to report here. Okay, so for the first tab, we're on premium bank overtime, which is a category in and of itself that you're going to report separately. So unfilter, select premium bank OT, because that's the only one we use for that second tab. And you can see it's almost comical how small of a number we have to input here because we don't issue overtime at DFA, but we're going to need to input it. So let me move that over. Premium overtime data. And you can see all of this is outlined for you. It tells you which one to use. Okay. Current year. You can copy and paste this. And these columns do line up. The ending liability, do line up to what's on the query. Okay. And then same thing, you need to do that for 24. Let me find the 24. Here we go. Let's turn our filters on. Premium bank OT. Same thing. We're going to copy and paste that to our FY24 data, and it pretty much hasn't changed. You see there's a penny difference, rounding, right? I think we all understand that Excel and rounding isn't exact science, so I'm not going to be worried about a penny. Okay, so that's your premium overtime. It's the only one you report here, and this is on the premium overtime data tab. Okay, then you have one more, and then you're almost done. So this is kind of a bigger bucket. This is the comp time leave balances, compensatory time, well, however you want to call that. We have identified all of those comp types, categories, I don't know, TRCs, whatever you call them these days, that are significant, need to be reported statewide. And we've created the queries to pull those for you. So you have the list here that tells you which ones need to be selected and reported. And this correlates or corresponds to the summary template as well as the MAPS policy and the guidance that we have issued. So when you go back to the query, you want to include all of these, but take out that premium overtime because you've already reported it. It's in the same query. So just like vacation and sick, you need to filter out the ones you're doing. Okay. So let's find that query again. Give me 1 second. My queries are moving all over the place. So here's our 25 comp query. Now we want to go back into our filters, select everything this time except for premium bank OT, which is the premium overtime. Okay, unselect that one, sum everything up. Okay.
Mark, while you're doing that, I just want to point out that this query will also include some of the comp balances that are not included. So for instance, if your agency has military leave time, that will be included in this query, but it will need to be filtered out because it is not part of the calculation.
Yep, and thank you, Audrey. And that's why folks make sure, I mean, this is also in maps, but it's here in the instructions. These are the only ones that you should be selecting. Now, for DFA, they're all there. The ones are, but not every agency is going to be that clean. There will be some agencies that have smaller balances in other comp classes or comp categories, sorry. Only select these. Okay. Where did I go? Okay, so here we are. Now we have our totals. So this is our FY25. Let's copy those. I'm going to put them in here. And again, same thing. Red lines up to the query titles. And this one's an easy copy and paste. Okay. Now, same thing on your FY24 data. Let's unfilter. Get rid of premium bank. And let's sum up everything. All right. Copy and paste into your FY24 columns. All right, so now we have everything. Again, instructions are up here for both current year FY25 and prior year FY24. Just follow those. So now you have all the data that you need. So the only other thing you're going to have to do is just make sure the journal entries are hitting the right credits and debits. And I mean, honestly, you're pretty much done. But each of the next 4-5 tabs goes through all the calculations. So here we go, and this is going to be hard because it's a really big page. But all of that data that we just inputted into those 4 tabs, the balances, the liabilities, have now been used to pre-populate all of those decisions, the more than likely than not, the whether it's 100%, 60%, 50% for sick leave, and all of that. And it's calculating your total leave liability for you. And this is FY24 if you read the tab. So this is showing you what, based on GASB 101, what those liabilities were as of 6/30/2024, which would have been June FY24, because we have to use that to help us with the restatement calculation. But you can see each category is calculated for you. FICA is added. Those salary related payments that are required to be added are added for you automatically. Okay. And then same thing, premium overtime, all the comp leave, everything is rolled up and it shows you the calculations, the 100% for comp, the 100% for premium overtime, your 60% and 50% between the 2 different types of sick leave, and then 100% for annual. Okay, it's all there. That's your FY24 tab. Again, you don't have to do anything here. As long as you input the data correctly in the 4 balance tabs, all of this will populate for you based on the rules and maps. Okay. FY25 tab, same thing. Get a little bigger. So now this is FY25, pulling from the FY25 data that you input on the balances tabs. Again, annual leave, sick leave, premium overtime, compensatory time, and your FICA is included on your salary related payments. Okay, so all that's there for you. Again, you don't have to do anything here. It's all being done for you. And then this, you have 2 different tabs when it comes to journal entries for your year of implementation. All right, we have the restatement, and then you have the actual booking of the FY25 activity. So this first tab, step 3A, is your journal entry for the restatement. Most of this is calculated for you. There is the journal entry you do have to enter yourself, but I'll show you how to do that. So it's showing you your total estimated liability due within 1 year, which is your total estimated liability here. And then your 70-30 split, remember Danny talked about that's the determination we made based on historical analysis that do within 1 year 70, more than 1 year is 30%. So let's doing all the calculation for you. So this is to help you create your journal entry. Again, all of this is hard-coded. You will not have to input anything other than the yellow stuff. And you read these instructions and let's see, where do I get these numbers from? Okay. This is one thing where you're going to have to go back and do some research because it's different for every agency. So if you go up here and read the instructions for cell F27 and 28, it tells you the amounts in F27 and 28 will need to be entered manually. These values should be pulled directly from your agency's 24 audit report. So what you are going to do is you're going to enter your short-term and long-term liability as reported in your audit last year, not as we've calculated in the spreadsheet as you reported last year, because what we've calculated based on GASB 101 is here. So that's how you do that. So I'll just show you how I do it, and I'm sure you CFOs probably have a better way of doing it. I'm going to pull up DFA's audit from FY24. So bear with me. I should have had this down and I forgot. So here's our FY24 audit. And, you know, those of you expert accountants out there probably know exactly where this stuff is in your financial statements. I do not. So I'm going to Control F. And if you can spell right, you'll find it. And then you're just going to look for your calculations. Now I can tell you DFA only records short term. And it's, you know, depending on what you all do, those decisions were in the past were made at the agency level. I think I missed it. So give me a second here. Okay, so here we go. Now you can see this a little bit better. So here's our note from last year. And you can see DFA total compensated absences were 1.1 million. Due within 1 year was 1.1 million. So they had everything as short term. Now your agency may have both. Okay. So in this example, and I'm going to move the audit to the side so you can see what I'm doing here. So in this example, we're only going to have short term at DFA. Okay. So you're only going to have short term, which is 1143645, and there is no long term in DFA's audit. So now you know what the restatement is going to look like. So these are your amounts that you have to restate against your unassigned fund balance. And this is one entry where, and again, these are full accrual entries. Let's not forget, this is a full accrual entry. We generally don't allow agencies to hit fund balance accounts unless there's a cleanup issue that needs to be resolved. This is one of those instances where you are going to be directly hitting that fund balance, and we're using unassigned because that's kind of the standard default. Now there may be a point in time where an agency may have to reclassify something to restricted, but you can work through your ACFR accountant on that. So generally speaking, we're going for unassigned. So this is how you do that entry. So this is the restatement entry that will need to be done in your full accrual ledger in July, August, whenever you get to around to doing that. And you just have to kind of understand. So it's actually an increase, right? So if you look at this, it's an increase. So you're actually going to increase your liability. Okay. So, and I know sometimes negatives get confusing with debits and credit and all of that, but you're going to increase your liability, decreasing your fund balance. Okay. Does all that make sense? I hope all that makes sense, and then you want to make sure that your totals all tie up, and there may come a point in time where we automate this for you. It's just not there yet. So that would be your journal entry. And Audrey, let me know if I'm missing anything or if that all looks right. I think my eyes are going blind, but I think it looks okay.
That looks perfect, Mark.
Credit, debit. Okay, so then there's your restatement entry. Now this is going to be different for everybody, but I assume for the majority this will be an increase. I think I would be surprised if there's anyone out there where the restatement is not an increase, just because we're bringing in more types of lead than we've ever recorded before. Okay, so that's your restatement, and then you would use this as supporting documentation for your journal entry along with the query, and that should suffice, as well as for your auditors. And then you can provide the auditors additional information with that larger query if they have questions, or they can always contact DFA and we can provide them with any other supporting documentation they need for the assumptions that were made as we went through this project. Okay, so that's journal entry number 1. And remember, this will only be required in year 1, implementation year, which is FY25. And FY26, all you're going to need is the next journal entry. Okay. All right. Good. Okay, and again, all of this is outlined in the instructions. So really read these instructions because they're very helpful and they're worded very, very clearly. Okay, now you move on to the second journal entry that's going to be required, which is the current year calculation of your due within 1 year, more than 1 year, and your expense. Okay, and again, all of this stuff on top is pre-populated for you based on those balances you entered, mapped into the breakdown of each type into these spreadsheets. So you have your 70%, 70-30% split based on your total liability. Now you have your due within 1 year, which is 1.6 million. Okay. Has all of that there for you, has your differences. So your journal entry here, and we're going to standardize the use of one single expenditure account code on the full accrual ledger. There's really no reason for more than one on the full accrual. And I can tell you, it's all over the place right now. I looked at 5 different agencies yesterday and all 5 use a different expenditure account. So we're trying to standardize that to make it a little bit cleaner. But here you go. So now what you're going to do is be recording the difference. You are recording the difference is what your journal entry does, which is similar to what we do now. After you get done doing your calculations, you record the difference. Okay, and that's the same as we have done. It's just the calculation to get to that point is there's a lot to it. So again, if the negatives, positives are confusing to you, because to me, I'm always living in credit and debit land. Now I see a negative number, things get a little wonky. Just kind of look, you can see that the liability from FY24 to FY25 has increased. Okay, has increased. So you would expect that your expense will go up and your liabilities will go up. So you're going to credit your liability and you're going to debit your expense. Okay, so just make sure you type everything in right. And again, we may automate this one of these days, but for now, we just haven't gotten to that point. Okay, Audrey, everything look clean there? Did I miss anything?
You look good.
Okay, so there you go. There's your second journal entry. So like theoretically, go enter these entries into share in the full accrual ledger and work with your act for accountant to make sure everybody's comfortable with it. And then you're done, other than obviously disclosing it in your note disclosure. And I think as I've been reading through some of the audits, I think there are agencies that have stuff about, compensated absences in your either MD&A or just other accounting policies. You may need to kind of update some language throughout the audit in other areas as well, since the change. But for the note disclosure itself, again, all of this is outlined for you in the instructions, but, populates for you. So here's your note disclosure. You can see the beginning balance was restated, and there's your restatement. The increases that we've calculated year over year, and then your amount due within 1 year, all that good stuff, which is required. So if you look at this and you go back to our journal entry, the 194 was calculated here. Here's your journal entry. There's your increase. And then the restatement, obviously, if you go back here, you can see there's your number. So it all is just kind of flowing through into the note disclosure for you. And then obviously this is your ending due within 1 year, and the remainder is long-term, which would be on the face of your financial statements. So that's how you do it. For me, like, this was my first time running through all of this. I've done compensated absences before at an agency level years ago. It's been a while since I've done it myself, since I'm not in that position anymore, but these templates are really helpful. And once you get comfortable with just pulling the queries where the data comes from, it's going to work out really, really easily. I think it's going to take some time to get used to. I don't want to make it sound like this is easy for everybody. It's going to take some time getting used to the queries and putting the data in there, and then obviously getting into your financial statements, but it's pretty clean. So with that, Audrey, do you have anything to add that I may have missed or not said correctly?
No, you did a great job, Mark. I have anything else to add.
I'm pretty sure I had nightmares about it last night, so All right. Well, Danny, Bailey, Heather, Audrey, like we're pretty much at the end of the presentation in and of itself. Again, we will be sending all of this out to the CFOs probably end of next week. We don't want to get it out too soon because you just can't be doing it yet because we're not done with the fiscal year. But we'll get it out probably by the end of next week. That'll include the policy itself is in MAPS. So when MAPS is published on July 1st, it's already in there. Okay, we've already got the final policy in there. But we'll send out the templates. We will send out the name of the queries. We are recording the video today, so we'll figure out where we're going to publish the recording of the video. And then as always, like your act for accountants, myself, Heather, Audrey, we're all here to assist as you guys start in working on this. Now, just remember, please do not start calculating your compensated absences until probably mid-July. And Audrey, I don't know if you can look at the calendar and tell me the date, but I think the final pay period is July 4th. So processing of the final pay period is the next week. So ending balances are really not official until after that final period. So I would say mid-July is when everything in share would technically be finalized from a balance perspective. And Audrey, if you want to confirm for me, I would appreciate it.
Would be the earliest they would be available would be July 10th. They will not be complete in HCM until at minimum July 10th. So I would not even consider running it until after July 10th using the 6/30/25 date on your query.
Okay. Yeah, and that's a good point because when you run these queries, you got to run them as of 6/30/2025 to get your FY25 data, and then 6/30 of 2024 to get your FY24 data. So that's your criteria. And I'll try to make sure we have that in the email that we send out to you all next week. So with that, I don't know, Danny, if you or Bailey had anything to add, and then we can open it up for anyone to raise their hand or put a question in the comment box. But Danny, did you have anything else?
I think you did a great job working through the templates. Hopefully you all can see, it's share reports, pulling it down. And this process, I just want to kind of reiterate because we work with governments across the country on this to get to all of this, to get the entries, to get the analysis, all of that stuff. That would take weeks, on your own for each individual agency. So hopefully, the tools that the DFA is providing kind of help you out and help you. One less thing you have to worry about, right, is just complying with this new GASB pronouncement. So that's about it.
Bailey, did you have anything to share with us? No. Okay. All right. Well, we had this scheduled to 11 o'clock. We will let you guys out early, which very rarely happens with Mark at the helm, but let's open it up for any questions. Does anyone have a question? If you want to raise your hand. Okay, so there's a question. And again, if you have a question, raise your hand, we'll call on you. Or if you want to type it in the comment box, feel free to do that. There's a question, since the salaries are based on 6/30, when we run the queries in August for the audit, if we use a date of 6/30, will the report still reflect 6/30 salaries? Yes. So that's why it's important for you to use 6/30 as the cutoff date for the query, because it is hard coded to pull the salary as of 6/30 as of the date that you run the query. So if you were to pull it with the wrong date, you might have incorrect data. So please make sure you use 6/30. And if it's 24 for the first year, make sure 6/30/24 for the 24, your prior year data, 6/30/2025. So it's set up that way specifically because that's how the GASB guidance requires it to be reported. Okay, great question, RC. Thank you. Jose says, Danny and his team also put on a valuable podcast surrounding new GASBs, including GASB 101. Someone's giving a plug to the
Thank you, Joe. I appreciate the plug. If you can just maybe share my email address, website, LinkedIn too in the chat. Just kidding.
All right, now we're not here to plug folks. No, but we do agree that this engagement we've had, at times was frustrating, and it more so just because we internally at DFA, like this was a struggle for us to be able to figure all of this out with so many leave plans and personnel policies and the different branches of government, and to get to a point where it would work for everybody and make it as easy as possible so you can spend time doing other things rather than calculating compensated absences. So yeah, it's been a good engagement, and I think we have a good product, and I think it's a product that we can use in the future, and you all won't have to spend any money bringing contractors in or anything like that, because it should be easy enough to do on your own, or reach out to the ACFR and they can walk you through it if you're still not quite sure. Like, I feel like this is a good product. So we've I don't want to say enjoyed it, because if you enjoy GASB stuff, we're probably never going to be friends. But it's been successful. I'll leave it at that.
And you know, we show it and we're like, here's this, and it's like, you know, all lined up. There were a lot of hours of discussions, evaluations, different approaches, different thoughts to kind of get to this point. And so you know, if you have those types of questions or interest in this, you know, the team at DFA can kind of talk you through that thought process and how they ended up where they ended up.
Yeah, and I will confirm that every one of the assumptions made, every one of the thresholds set is backed up by historical data. Like, that's one of the main reasons, or biggest reasons, Audrey Beck is here with us. She's our payroll bureau chief. She's been able to help us pull all of that data statewide, analyze it, put it into an understandable analysis through data mining to get us where these figures make sense, where they're backed up by data and, you know, should be auditable. So any other questions? Either we did a really good job and you all get it, or you just want to get out of here. I'm not sure which one it is, but Esmeralda's asking, are the queries going to be public, or would we need special permission to access them? So these are HCM queries that will be public. So as long as you have access to run HCM queries through the HCM query viewer, you will be able to run them. Go ahead, Audrey.
They will not be public until after 6:30. We are not going to make them public until they're actually usable. And we will be removing queries that were used in prior years. So you cannot rely on any query that you used in a prior year to pull this data, because we will be removing those from HCM.
And that's a good point, Audrey. Thank you for that reminder. Yeah, and if you were to try and use one of the queries that we were using in the prior year, it's not going to get you the right data, because those were set up for just sick and annual, the way we used to do it. So definitely, and yeah, they will be public. They will be public. Actually, I think they are public right now, but we're going to take them down, finish fixing them, and then we'll make them public by the time we send all of this stuff out. Thank you, Rachel. Any other questions? Molly's saying, will you be sending the PowerPoint slides? So we will send the PowerPoint presentation along with the templates and the guidance that we send out to everybody next week. Absolutely. We'll send it all together as a package. Any other questions? Any other closing remarks? Audrey, I'm going to turn it over to Audrey Beck to close us out today.
Okay, guys. Thank you all for attending. I do hope you all enjoyed the presentation, or at least found some value in it. We did spend a significant number of hours doing our research, discussing what we thought was the best practices, evaluating all agencies and what their salary plans stated. So hopefully the information we're providing you will meet your audit needs. If your auditors have any questions or concerns, you know, we are available to help in this, in presenting an understanding to your auditors on how we came to these decisions. And remember that while we're showing you the queries that provide the total numbers, in the event your auditors do want to do testing on a specific data set, you can pull down the larger queries with all of that information on each individual.
Okay, thank you, Audrey. Well, if that's all we have, thank you, everybody. Thank you, Danny. Thank you, Bailey. Thanks, Cherry Becker, for helping us put this together. Good luck to everyone. We will be sending all of this out next week. There is a second session this afternoon, so if any of your staff missed this class, please, share the invite with them for this afternoon. We had a pretty big crowd this morning, but feel free to share that with them. And then just kind of be on the lookout end of next week for all of this to be emailed to you, and as well as the policy being published in MAPS. And always feel free to reach out to the ACFR unit once you get to the point where you're doing these calculations. If you're struggling or if you're not quite sure, we will all help you with that. And with that, Bailey, if you want to end the recording, we will let everybody leave. Everybody stay safe, stay healthy. Good luck on year end.